So as we learned last year with these monumental programs, these historical milestones do come with some challenges as these program offerings are being revamped. Information is being released and by the federal government on an ongoing basis. And we know many business owners are seeking guidance, and we're hoping to help you navigate through all this information as we know it today. However, it's still a dynamic process. And as of right now, all the content you will hear on this webinar is accurate. Our speakers are working very hard to provide you the most up-to-date information and guidance available. All right, let's get going on with our program. So today we have Kathy Mason, Stakeholder Liaison from the Internal Revenue Service, who will be giving us a brief overview of the Employee Retention Tax Credit, as well as some updates and some tips. We also have Sarah Huang, CPA from Clark Nuber, who will talk about some recent changes and how it impacts the employers and why this credit matters for organizations, and also some advice on the application process. And then we're going to hear from a couple of our small businesses to get their perspective on this. And today we have Sharon Ku Fong, owner of Signorama, and also Yulia Poltorok, bookkeeper from the Sammamish Rowing Association. And now I'm going to turn it over to Kathy. Kathy.
Well, thank you so much, Krista. That was an amazing overview of the wonderful work that you guys do, and a great introduction. And we've only got an hour, and I know you guys are really eager for information. So, let's go ahead and get started. You can move to my first slide whenever you would like. I'm going to start by giving you a whirlwind tour, and I mean a whirlwind tour because at this point, we've only got an hour, and I kind of want to focus on what's going on right now more than sort of historical. But I know some of you are going to want to go back and retroactively claim this credit, which, by the way, you certainly can do. So, in 2020, the very first piece of legislation, the CARES Act, established Employee Retention Credit. Employee retention credit is for businesses to retain employees. Okay, so it's for businesses to take care of their employees, not their owners. And I'm going to talk a little bit about owners here in a little bit. It's really about keeping your staff with you even when your business is being challenged, et cetera, et cetera. So if you were a small business, and the most eligible small businesses originally were 100 or fewer employees, full-time employees, and the credit was up to $10,000 total wages per employee. The credit was 50%, so $5,000 per employee during any period when you were under a shutdown order, okay, basically, or a partial shutdown order, or your gross receipts dropped to below 50% compared to what they had been like in 2019. Remember, we're in 2020 with the original legislation, okay? And originally, you could not claim employee retention credit if you had obtained a payroll protection program loan. Then the program was first modified at the end of 2020 with what we refer to as the Relief Act, which was passed toward the end of the year. The biggest change there was that they removed that restriction about the payroll protection program loans. So businesses who had obtained a payroll protection loan could then also claim an employee retention credit, but not with the same wages. Okay, you couldn't double dip on the wages, but wages that weren't used for the PPP loan, eligibility and qualification, could be used for employee retention credit. So you could use wages during different times, or wages that weren't necessarily eligible for the PPP might be eligible for IRF instead. Okay, so that was legislation number 2 with the first set of changes. Then in March of this year, along came ARPA, the American Rescue Plan Act. And what that did was to increase the credit. Okay, so the maximum credit per employee went up quite a bit. Okay, it was still based on 10,000 of wages, but it was 10,000 of wages per quarter. So literally 40,000 wages for the year. Okay, and instead of being 50%, it was 70%. So the maximum credit per quarter per employee if you qualified during that quarter, would be $7,000. It went up by quite a bit there. It also made it loosened the restrictions, I would say, a little bit with regards to the decline in gross receipts. Instead of having to have a 50% decline, you only needed to have a 20% decline. And there were a couple of other changes too, but those were the two biggest changes I would say that came along with ARPA. And we skated along with ARPA for a while, and it certainly made the credit available for, at that point in time, all of 2021 for IRC. But the infrastructure bill that was passed and signed into law last month in mid-November basically retroactively terminated the employee retention credit as of the end of the third quarter. And that's where I want to kind of take off with the slide today. And I'm hoping that Sarah and some others are in the Q&A later, because this was a whirlwind, can dig a little bit into some of the rules, especially if you have questions about your specific business. But I want to focus now on some of the current topics of interest. The Infrastructure Act last month did throw people for a loop, since of course it retroactively ended the IRC as of September 30th for almost all businesses, except for what we call the recovery startup businesses. What are those? We've got some key points here on the slide, and it's important to note that the business must be a new business, which means the taxpayer has begun carrying on a trade or business that has started to function as a going concern and is performing the activities for which it's organized. So converting a sole proprietorship, which is already conducting a line of business, into, for example, an S Corp after that date of February 15th would not work. It needs truly to be a new business and a new line of business for it to qualify to be a recovery startup business. Keep in mind the overall $50,000 limitation there, which is the last point on the slide, oddly enough, but the credit for these recovery startup businesses is limited to $50,000 total. So with a max of $7,000 per employee per quarter, it could happen fairly quickly. But if this is the first quarter you're doing it and the last quarter it's available, that's still $50,000 you don't want to leave on the table. Bear in mind that the recovery startup business is available for both the third quarter and the fourth quarter. The big change is that it is the only type of business that will qualify for an employee retention credit in the fourth quarter. Okay. And by the way, a 501c3 entity, a charity, can be a recovery startup business. That is in one of the notices that we published after council was reviewing the legislation. And a recovery startup business is considered to be a quote unquote small eligible employer. What that means is that they can claim an advance on the IRC for this quarter. So they could go ahead and submit that form 7200 and request an advance on the refundable portion of the credit that they haven't already reduced employment taxes to take. Okay. Now, not specific to a recovery startup business, but I know you guys have had questions about this before. So I just want to briefly let you know that later, or well, after the last time we were together, so somewhat late last summer, we did come out with guidance that basically clarifies that whole concept of are owners eligible? And the short answer is no. Okay, let me just kind of put that out there. In general, wages paid to an owner are not eligible. We always knew that a sole proprietor for a Schedule C business or a Schedule F business that files on a 1040 with their self-employment, instead of wages and having the FICA withholding, they pay self-employment tax. They were never eligible. But there was the question of, well, what about S Corp owners that receive wages that are in the payroll system? Are they eligible? I've been telling you, and it turns out I was right, that generally speaking, I doubted it, because the concept is sort of an equitable thing. Owners are really not supposed to be eligible. It's to retain employees. It's to retain and to keep and to not lose that knowledge base and that experience base of your employees. So majority owners and spouses in an S corporation may not use their own wages to claim an employee retention credit. This is really weird, but funny. Unless they are orphans with no living siblings or children. Okay, so if you have an S corporation owner whose parents are deceased, they have no brothers and sisters, and they have no children, then they have no related parties, and they would be able to claim the IRF. We think that is probably going to be a pretty rare situation, but it could happen. You can't make this stuff up. It's right there in the examples in the guidance. Also remember that an S corporation owner who employs their relatives can't include the wages of those relatives. So if you're employing your kids, your brother, your sister, your mom, your dad, their wages can't be included for purposes of claiming the credit. And that also includes anyone who is a full-time member of the household of the owner, even if they aren't related. Again, you can't make this stuff up. Okay, now let's move on to slide 2, or my slide 2, the next slide, I would say. Okay, so, what happened when they passed this Infrastructure Act in mid-November? A lot of businesses were in anticipation of claiming an employee retention credit in the fourth quarter prior to enactment of this legislation in the middle of November, had been holding back on their employment tax deposits and perhaps applied for and might even have received in advance on Form 7200. Properly so, at that time, it was still available. They were doing what they were supposed to do. But then we find out in mid-November, oops, no more, we're taking it away. So what happens? Okay, so if a business applied for an advance for the fourth quarter using Form 7200 and it was not processed as of the date of the legislation, our submissions people are supposed to be catching those and rejecting those back to the business with a letter that explains, the credit has been retroactively terminated. Your Form 7200 can't be processed. Okay, that one's fairly straightforward, fairly easy. It's unlikely that those would be processed after that date. Possible, but not likely. But, if you're a recovery startup business, they will go ahead and honor those requests, and they should be paying on the 7200 for recovery startup businesses. That's the word I've been given. If, however, you already received an advance to which you are no longer entitled, it will have to be repaid. And these will be due on the same date your employment tax return is due for the period that includes December of 2021. Now, for most folks, they are quarterly. Almost everybody is a quarterly employment tax reporter, right? You report for the first quarter, January, February, March, calendar quarters. So that December is going to fall in the fourth quarter, and that 941, which is what the majority of employers use to report their payroll tax, is due on January 31st. So that is when that 7,200 advance would need to be repaid. It does kind of make sense because you also reconcile on that fourth quarter 941. Okay. Now, if you don't repay that by the deadline, then failure to pay penalties will apply. However, they will be waived if it is paid by that January 31st date. So there is definitely a waiver in place, but you do have to pay attention and respect the deadline. Now, what if you were reducing your employment tax deposits? Okay. The penalty for failure to deposit and to pay on underpayments of employment tax will be waived as long as the applicable deposits are made by the due date for deposits on wages that are payable on December 31st, 2021. So most of the small businesses, I think, that are here today are probably monthly depositors. So your payroll for the period that includes December, the end of December, is for your monthly depositors going to be due in the middle of January, January 17th to be precise, because the 15th falls on, I believe, a Saturday. Okay, so that's fine. You get those 15 days, but you do need to make, that deposit for the taxes that you held back by that date in order to receive the waiver on penalties. Now, if you happen to be a business that is a semi-weekly depositor, then you might be looking still at the middle of January. You might be looking a little sooner than the 17th, depending on when the 2 weeks fall. If you are a 3-day rule, then you're looking at much earlier in January. And if you are one of those unlucky people that has $100,000 payroll liability on December 31st, then you have that 1-day rule, which means basically January 2nd. That will need to be done. But again, as I said, most small businesses are monthly depositors. So as long as you catch up on those employment tax deposits by January 17th, you will not be assessed any penalties. Okay. But there will be no penalty waiver for any employment tax deposits that are due after this notice that just came out. It's notice 2021-65 is published in the Internal Revenue Bulletin, which is supposed to happen on December 20th. So unless you're a recovery startup business, do not try to withhold any deposits on or after December 20th, because you cannot qualify for a waiver at that point. Okay. And just a reminder, the penalties that I've been talking about up till now are sort of the statutory automatic penalties: failure to file, failure to pay. This waiver in Notice 2021-65 covers those for people that were anticipating, and it's pretty much a blanket waiver. You don't have to explain yourself. You basically say, I was anticipating the IRC, I need the waiver, you get it. But in general, you can also at any time establish reasonable cause and receive relief under Internal Revenue Code section 6656. So I just wanted to mention that. There are other times when you might, ask for relief of a penalty just in general circumstances. And as long as you qualify with reasonable cause, you could also get relief under that particular code section. Okay, and then I do have just one more slide, because I know we want to keep this moving. And I can see kind of in the questions there that people are already saying, well, I applied a while ago. Oh my gosh, where's my money? What is going on? And as I say here on the slide, the short answer, unfortunately, it might take a while. So let me just give you some statistics and some information. As of December 1st, we had 3 million unprocessed 941 forms. Okay, so let that sink in a moment. 3 million. Now, most of those would be paper. I'm going to be honest with you, because when you do it electronically, it tends to go fairly quickly. If you're filing on paper, it's probably among those 3 million. Tax returns are opened in the order received. If you did file electronically and you received an acknowledgement, you don't need to do anything, just be patient. But it probably will come fairly quickly if it hasn't already, if you filed electronically. We are working hard to get through this backlog, and please don't file a second tax return if you filed on paper, or contact us, because that just slows things down. It really does. Trust the process. If you know you sent it in, it's being processed. You're just going to have to be patient. And I hate to say that. That's not what I like to say, trust me. But we have a huge backlog right now. Also, as of December 1st, the total inventory of unprocessed amended employment tax returns, that's the 941X, was approximately 412,000. Okay, that's still a pretty big number. But many of those can't be processed until the related 941 has been processed, so the original one. Okay, so if you send in a 941 on paper, and then later on decided to claim employee retention credit and then submitted a 941X for the same quarter, you may be looking at a double weight situation, because the original has to be processed and then the amended is processed. So, not all of the returns that are sitting there in what we call the pipeline involve a COVID credit, but a lot of them do. That's really what's backing things up, is that a lot of folks have found out how great this is and want to take advantage of it, which we love, but it is slowing things down. Good news, we do have inventory being worked at 2 different campuses, Cincinnati and Ogden. The staff there are pretty well trained and they are working overtime. I promise you that. So, at this point, we need to ask you to be patient. We will get there. We really, really will. And so, as I like to say, small business rocks America, and you guys are the best. And now I'm going to turn it back over to Samantha and Krista and all the other great, and it looks like Sarah is up next. There you go. Thanks,
Yep.
guys.
Thank you, Kathy and Sarah. Yep, we're turning it over to you. Go ahead.
Perfect. Well, thank you, Kathy, for giving that great overview and some insight of what's actually going on at the IRS. I completely agree that I can promise you they are really working hard, and there's just a lot of data for them to get through right now. This credit's been overwhelming for taxpayers, and unfortunately, all these amended returns have to be filed via paper, which only slows things down even more. So what we're going to do is kind of build on the information that Kathy gave us here and take it one step further and try to give you some practical information on how this credit can work for your business. So I know I personally have helped probably over 100 different businesses since the beginning of this year work through this employee retention credit, answer their questions, do the calculations, figure out the interplay with the PPP and other relief funding options. And it's been amazing to see the real life money that has come from this thing. And yes, we have seen organizations get their actual refund checks. So those are coming. The IRS is processing those, I can assure you. But again, as Kathy mentioned, just be patient because it does in fact take some time. So we'll do a quick, walkthrough of some of kind of the real benefits that the credit has for organizations. Touch on some of the latest guidance that Kathy mentioned, and again, build on that a little bit. And then kind of recap on eligibility, as well as how to claim the credit and what you want to have in your files for documentation purposes. And then lastly, quickly touch on common errors that we are seeing, because unfortunately, these errors are going to delay your refund process even further. And what we don't want is to have you be waiting in the IRS backlog for 6 months only to find out that your refund claim has been denied because your form wasn't filled out correctly. So touching on the real benefits of this credit, I promise you this is real cash. So you'll see on the next slide, this big pile of money here, and it's real dollars. You file these credit claims. It's not just some credit that is on your income tax return or flows through on your 1040, comes through as a payroll tax credit. And again, you will get an actual refund check here if you choose to get the refund check option. You could also choose to have that payment applied to a future quarter as well. But again, it's real cash that is going to be coming back into your pocket one way or another. So how is the credit calculated? It's really pretty simple. Again, Kathy mentioned this at a high level too. You take your qualifying wages up to $10,000, depends on which year you're in, how that $10,000 is calculated. And then you multiply it by the percentage. 2020, it's a 50% amount. 2021, it's a 70% amount. And that's the number of your credit. So again, it can be up to $7,000 per person in Q1, 2, and 3 for 2021, and up to $5,000 per person in all of 2020. Again, real dollars coming back here. So the next slide, I've highlighted just a handful of kind of real life examples that we have helped over this past year. We worked with a lot of restaurants because those ones have been shut down or facing some sort of capacity restrictions, which we'll talk about some of the eligibility requirements in just a second. But restaurants usually are easy for them to qualify for this credit. So we have one client who has about 15 people on staff, many of them part-time, and over 3 quarters in 2021, they got $110,000 credit coming to them. We have a hair salon. Those two are pretty easy to qualify under because hair salons had so many restrictions for social distancing and such. We had one that we were helping out actually in New York City with about 110 employees, many of them, again, part-time. So they qualified as a small organization. And in 2021, over Q1 and 2, it was over $1 million for them over those 2 quarters. And then they were able to also claim it for 2020 because they fell below that 100 employee threshold. And it was another $500,000 for them. So that one was a really big win for them. There's a daycare in Bellevue that we helped out, about 60 employees. For 1 quarter alone, they were able to qualify, and it was $230,000 for them. They were very excited about that. And then lastly, a consulting company. So we have lots of other professional service companies that have seen a decline in gross receipts over the past year. And that is one of the other eligibility requirements there. And this one has about 25 people, and over 3 quarters, it was a little over $500,000. Again, real dollars that are coming back to them as the organization, in addition to PPP loans that they've already gotten. So it's a huge win. You know, they're eternally grateful, and it's allowing them to make some business decisions going forward that they didn't think they would be able to because they didn't have the cash on hand before. So the next slide here, I've touched on kind of some of the key changes that have happened since our last webinar in May. So back in May, we came to you and gave you a run through over you know, a bunch of the changes and what the rules were regarding the employee retention credit. And so there's been a lot of additional guidance since then. If you want to go ahead and flip to the next slide, as Kathy mentioned, the credit has now ended for most organizations, unless you're one of those recovery startup businesses, I should say. But for most organizations, the credit program has now ended as of September 30. But you can still go and claim the credit for those back quarters. I just want to really make that clear, because there's been a lot of confusion on that, where people think it's ended and so I can't go get the credit anymore. Well, you can. You just can't claim it for those current quarters anymore, unfortunately. And then in August, the IRS came out with 2 additional, or maybe it was 3 notices, I can't quite remember, a couple notices there that provided some extra guidance on some of those key questions there. And some of those key questions will change whether or not you are eligible for the credit. And so Kathy kind of walked through some of those, you know, whether business owners are eligible for the ERC and things like that. Some answers surprised us and some made us happy. You know, again, when it comes to the gross receipts test, one of the big things was, are PPP loans included in that? And the IRS says no, PPP loans are not part of the gross receipts calculation. Neither are restaurant revitalization fund grants or the shuttered venue operator grants. And so that can have a significant impact on your ability to qualify for the credit. So again, a lot of organizations kind of ruled themselves out of the credit initially, but with this guidance that has come through over the past few months, a lot may actually be eligible now. And so if you previously ruled yourself out, I'd highly encourage you to take a second look just to make sure that none of this guidance is shifting your eligibility here, because we, again, would hate for you to miss out on this credit because it can be such big dollar amounts there. And then lastly, you know, there is some additional planning opportunities now as a result of this guidance. We actually can double dip on wages when you have the ERC and a shuttered venue operator grant or a restaurant revitalization fund grant. There's a certain time period where that is now allowed. And so for those arts organizations or, you know, performance organizations that qualified under the shuttered venue operator grants, or those restaurants that got the RRF funding, you know, there are some additional planning opportunities here. So don't think that you have this no double dipping provision for everything, because there may be ways for us to get strategic and help you figure out how to get, again, the most bang for your buck there. So quickly touching on eligibility and how to claim the credit, you know, there's kind of a 3-step process, which you'll see on the next slide. One, you have to make sure that you understand your family of related entities. So if you are a business owner, but you have 2 entities that you own 100%, those entities need to be grouped together and analyzed together as one. And so that's one of the key things that we are seeing organizations not realize right offhand. So you may have, or maybe you have multiple different business entities, which you own 100% of one, 75% of another, and maybe it's 51% of a third of them. Those all need to be grouped together under aggregation rules potentially. And so you really have to make sure that you understand, again, what is your family of related entities, because that will be an important factor in your eligibility. Now, there's two ways to be eligible for the credit. One is through some sort of impact from a government order that is causing a suspension in your operations. So think restaurants, they were subject to certain capacity restrictions. That's a type of shutdown. A hair salon, they could only have a certain number of people there, or everyone had to be 6 feet apart. That's a restriction. So those type of restrictions from a government order is what is going to allow you to be eligible there. The other option is facing a significant decline in gross receipts. In 2020, that was a more than 50% decline. 2021, that was more than a 20% decline. Again, make sure you're looking at your family of entities as a whole, because gross receipts for everybody needs to be analyzed. If you have multiple entities and you're trying to qualify under the shutdown provisions, only one of those entities actually needs to qualify, and then the whole family of them will be eligible. So it's a little bit of a unique situation there that can actually work to your benefit. And then lastly, the other key thing that you need to know is what is your number of full-time employees on average during 2019. You don't count part-time people, strictly full-time people, and you look at the 2019 average amount there, because that's going to tell you if you're a large employer or a small employer, which then impacts your calculation. The next slide here, we have just some reminders on documentation for your files. If you do go ahead and claim the credit, what do you need to have in your files? You need to have the government orders. You need to know when those orders are in effect, how they're impacting your business. That is super important, because that's would honestly be the first thing I would guess that the IRS would ask for if they go ahead and audit you there. Gross receipts data, if you're claiming eligibility under the gross receipts method instead, then you need to have copies of your gross receipts data on file. Everything from 2019 to 2020 and 2021, whichever quarters you were claiming, you need to have that documentation there on file. For aggregated entities, you need to understand which entities are included and which ones are not, because you may have multiple entities that you own, but some aren't included and some are. And so you'll want to have some documentation in your files on that, how that ownership is structured, if it's through family attribution rules, that then you have to pull those people and those entities in together. That's going to be really important and can honestly be a very complicated analysis to go through. So make sure to reach out and get some professional help if you end up in that situation. And then lastly, payroll data. You need to have copies of your originally filed 941s, those 7200s if you were claiming that advance refund, information on payroll reports, and documentation that shows that you are not double dipping on the credit. If you had a PPP loan, make sure you have some sort of paperwork that shows, okay, well, this $15,000 of wages, it's been allocated now, and we're saying 5,000 goes to PPP and 10,000 goes to the ERC or whatever it may be, but just some documentation on how that payroll is all going to shake out. And then how do you actually get your refund check? They do come, again, I promise you that. You can file it on a current form 941. That's always the preferred method to go ahead and make that claim for the ERC. But again, now for many organizations, they are no longer eligible for the ERC, unless, again, you're that recovery startup business. And so that's not really an option anymore. So it's through that amended form 941. 941X has to be filed by paper. You need a separate one for each quarter that is eligible. You want to be mailing these in separate envelopes to the IRS for every time that you are filing that amended return. And unfortunately, it needs to be done via paper because there is no electronic filing option there. Make sure to, again, work closely with your tax preparer too in this process, because that credit will impact your business income tax return. Essentially, the credit becomes additional taxable income to you, which is a bummer. I realize that, but in the end, you'll still walk out ahead. I mean, if you figure about a 20% corporate tax rate, you're still going to be making about 55 cents to the dollar for those 2021 credit claims, which is still good. I mean, I'd rather have 55 cents to the dollar than nothing at all. So it's definitely still worth the whole investigation to see if you're eligible there. And so real quickly, I want to just touch on some of the common errors that we are seeing in this refund process. We see a lot, unfortunately, but they can be fixed. And so first of all, making sure that you understand your employee retention credit interplay with your PPP loan. We see a lot of people who have applied for PPP loan forgiveness without evaluating their ERC eligibility. And in some cases, it has turned out negative for them. I had one client who said, oh, well, we spent all of our PPP proceeds within like 12 weeks. Let's just go ahead and file our forgiveness and get that taken care of, and then we'll deal with ERC later. When we came around and did the ERC, we told them that if they had done a 24-week covered period, they would have gotten an additional $500,000 of an employee retention credit. But since they chose to only do a 12-week covered period for their PPP loan, they ended up cutting themselves short. And they totally could have done a 24-week. It wasn't like they had to do 12 because of, you know, payroll and retaining employees or anything like that. They just wanted to get the paperwork done and off their books right away. So that was a really sad situation when we saw that come through. So definitely make sure that you're understanding that interplay there. Definitely take advantage of those non-payroll costs for PPP loan purposes. Again, we've seen a lot of organizations just push their forgiveness through using only payroll costs. But had they done some non-payroll costs like rent or utilities, you know, some of those easy ones, then they could have boosted their employee retention credit. And the problem is that the bankers, they don't really understand this. And so they'll say, oh, you have enough wages to get full PPP forgiveness, just put that on. Don't worry about those utilities and mortgage interest or rent costs. You don't need them. But you may actually want to do it because it can get you a bigger employee retention credit. So don't forget about that. The 7200s, if you went through and did that process and tried to get those advanced refund claims, make sure that you are reporting that on your actual 941 for the quarter. We've seen a number of organizations that forget to reconcile these two forms there, and then it ends up confusing the IRS and screws up their ability to get those refund claims quickly. And so it just causes more problems for you than actual help. Make sure you're using the right forms when you claim the credit. The 941s and 941Xs have been revised over the year. Make sure you're using the current ones. Make sure you're following the current rules, because again, those have changed a lot recently. And then also, if you are working with a third-party payroll provider like ADP or Paychex or Paycom, I mean, there's a variety of them out there. I will say, don't assume that they understand how the credit is going to work for you in your specific circumstances. You know, they understand the credit, they know how it flows on the forms, they can do that properly. But if you have other things going on, like a PPP loan or shuttered venue operator grant, restaurant revitalization funds, I would highly recommend getting your CPA involved, because those third-party payroll providers are not going to be able to give you advice on how to maximize the dollars there and where those wage dollars are going to be best used. So you definitely want to be looking for some other extra guidance along the way. So that way you can try to get the biggest dollar amount possible there. The last slide here is just a variety of different resources on the IRS website. It links to additional documentation. We too at Clark Huber have a variety of articles on our website. I know One Eastside has been writing a lot of them too in their newsletters. Again, feel free to reach out if you have any questions at all about the program. I know it's complicated. There's a lot of unanswered questions still, but thankfully we have gotten a lot of additional guidance from the IRS over this past year. And so we can answer most of the big ones that have come up. And so with that, I will turn it back to Christina.
Yep. Thank you so much, Sarah. We really appreciate all really great intel. So next we have Sharon Ku Fong from Signorama, and we're going to hear from her a little bit about her experiences. All right, I turn it over to you, Sharon.
Hi, good afternoon. I'm Sharon, and my husband and I own Signorama Redmond. And we started our business in June of 2017. And like every small business, we got impacted with the COVID, and we had to lay off a couple of our staff, of whom 2 have joined us back. And we are actually a franchise. And in June this year, we had an expo that was organized by our franchise company, the corporate company. And that was where I heard about ERC. We never knew about it, and they had their team talk to everyone, and we got to know what extra money we could get. And we have a third-party payroll specialist. We use ADP. So I reached out to them when I got back into town in the summer, and spoke to them, and they helped us get back some money for 2020, what we were eligible for. And I think we got the check back. We got that credit amount maybe about 3 months down the road, which was a big surprise to us. And we have been doing it, submitting it every quarter, but we haven't gotten anything back yet. And like we know, it will come back. We'll just have to wait.
All right. Thank you, Sharon. Appreciate that. And next, we're going to go to Yulia Potorik to talk about her experience with the Sammamish Rowing Associations. Yulia?
Yes, hi. Thank you for inviting me to this webinar. So Sammamish Rowing Association is a non-for-profit community rowing organization here in Redmond. We were founded in 1995 and operating in partnership with King County Parks and the City of Redmond. We provide a variety of rowing programs for middle and high school kids and adults of all athletic and physical abilities. So when the COVID-19 shutdown began, all our rowing programs were completely shut down from March till June. And then in June 2020, we reopened with limited programming, only single boats and like no middle school kids. And that continued until April 2021. And only now in fall 2021, we are seeing slowly coming back to normal. So if you look at the numbers, like in 2019, we had 650 participants. And in 2020, we only had 290 participants. And for the fall of 2021, we are slowly getting back. So we got 400. Personnel is one of our main resources. Our coaches are really critical to the success of Sammamish Rowing Association. So during the shutdown, it was really important and critical to retain them and keep them paid. So the number our employees, full-time employees, is around eight people, and depending on the season, we have between 15 and 25 employees. So when the shutdown began, we promptly applied for and received the PPP loan, and haven't heard about ERC, and it was not allowed for the PPP loan recipients anyway. So we received the PPP loan, used all the payroll to apply for forgiveness, got that forgiven. Then in January 2021, as we were considering applying for the second PPP loan, we heard about the ERC and that the rules were changing. And so we found out that we might be eligible. And that's when I first attended the webinar, just like this one, and found out that we can retroactively apply for an ERC for 2020 and start using it in 2021 as well. So there was a big decline in gross receipts. So that test was met, and we are small number of employees. So that qualified us for the ERC. So what we did, we had to file an amended return 941X for all 2020, and applied for it in March 2021, and 7 months later got a check. So in October, we finally got a refund. Then as we applied for the PPP loan number 2 in the first quarter of 2021, we originally thought that we are going to wait until we spend the whole PPP loan and only then start to apply for ERC. And then I attended another seminar, webinar like this, and found out that we don't have to wait, and we can concurrently use PPP loan and ERC. So that's when we learned about free consultation by Clark Newber, and so we met with Sarah, and she helped clarify all the questions that we had. So we started to apply ERC to the first quarter of 2021. Again, we had to file an amended return by that point because that was already May. So we are still waiting for a refund there. But starting in second quarter, so for the second and third quarter, we applied for the ERC as part of paying federal taxes through our payroll provider, ADP. So basically in second and third quarter, we didn't have to pay, we didn't have to pay payroll tax at all because the ERC credit was enough, more than enough to cover those. And then the average, there was an average we would receive 2 months later after the end of the quarter. So pretty much thanks to Sunnyside Park and Clark Newber for these webinars. In total, we are still waiting for the first quarter ERC, but in total we will receive $271,000, which is about 40% of the 2020 payroll, which really helped a lot because helped to retain our coaches, helped to resume our operations, and I can tell everyone, the board of directors and everyone I talked about the ERC to were really impressed by the by the amounts, and at first couldn't even believe it, but yeah, it's true, and it works. Thank you.
Oh, thank you so much. And it's so great also to hear that our programming is effective in bringing these resources to small businesses, because that's why we're doing this. So now we have a little bit of time for Q&A. I want to do a quick reminder. We are recording this webinar, and we're going to go ahead and send out a transcript of all the questions and answers, even the ones that were asked and answered here online. And you also get a copy of the video recording of the webinar, of course, the slides, and the resources that we listed here as a follow-up to you. So the first question, and I know Kathy, you had mentioned here in our Q&A box that you'd like to answer this live or like to be answered live. This question asks, are ERC eligible wages by quarter accrued, date worked, earned, or date of check?
That's a good one. And I have to tell you, Christina, I hit the wrong button. I was gonna
Oh.
type an answer, but then I goofed up. But that's okay, because I think it's a good question, and one that probably is relevant for quite a few of our participants. So essentially, you want to follow your payroll rules. All right. So if it's going on that quarter's payroll tax return, that is where your eligible wages are determined. For most people, they do payroll on a cash basis. So essentially, it will include anything that they've earned during that quarter. And so, you want to look at it that way. It really has to do with how you report your payroll. Whatever your normal payroll reporting procedures are, that's what you're going to follow. It could vary by business, but what you need to do is use your normal rules of accounting that you adhere to for payroll. Everybody does their payroll. I shouldn't say everybody. There is some variety in the way people keep track of payroll and compute it, but whatever your normal method of accounting is, that's what you want to use to determine your eligible wages for the quarter.
And I'll just chime in that this is different than your PPP loan program. So that has a completely different set of rules where you could take your cash basis wages or your accrued basis wages to meet your PPP loan program stuff. And so there's two sets of rules here, two different programs. Don't get confused. Many people are.
Thank you so much, both of you. All right, we have our next question. It asks, I filed a 7,200 in October this year and have not had any response from the IRS on that. What is the timeline regarding payments by the IRS? And I think, Sarah, you touched on this a little bit. Do you want to kind of recap that answer?
Yeah, I mean, and Kathy, feel free to weigh in too. I don't know. I haven't seen a whole lot of success with the Form 7200. And And part of it could just be user error by our clients. But initially when the form came out, the IRS said it was going to get you a refund within like 2 weeks or something. And I mean, they've just gotten flooded with these requests. And so I don't think that time frame is doable anymore. But now with the whole the retroactive cancellation of the ERC in Q4, I'm a little bit concerned that they're filing the 7,200 in October. I guess I would be curious as to which time period they're filing that for.
Yeah, I don't have any specific information on that. And Kathy, did you have anything to add to the Form 7200 intel?
Well, just what we put out in the notice that came out yesterday morning. So essentially, unless you're a recovery startup business, if you filed a Form 7200 in October and it hasn't already been processed, the chances of it being processed are probably slim to none, because you would no longer qualify since October would be in the fourth quarter. Now, on the other 7200s, I think what was happening is that they underestimated the volume that they were going to be getting. And so by the time they got to a lot of the 7200 processing, the payroll quarter was already over. And so instead of getting your quote unquote advance on the 7200, they basically were just processing a refund on the 941 instead. It overwhelmed them. And they're still overwhelmed, as I mentioned earlier, and Sarah sort of amplified on that. Right now, especially because the amended returns have to be done on paper, and that means that it have to be processed one by a human, it's a bit of a challenge. You're just going to have to be patient.
Yes. All right. Thank you so much. Good responses. All right. Our next question asks this. We have existed since 2019, but did not have employees until this year, 2021. Can we still qualify? Would that be Sarah? You want to take a first shot at?
Yeah, I mean, they should be able to qualify, assuming that they meet one of the eligibility requirements, and that being either subject to some sort of a government order that created a shutdown of a portion of their business or all of their business, or have a gross receipts decline. I mean, my concern would be if they were trying under the gross receipts method, they may not qualify because 2019 may be pretty low revenue numbers, and hopefully revenue has increased since then, as you have brought on payroll people too. But the shutdown rules may come into play for a period of time. Here in Washington, basically all restrictions have been lifted. Yes, there are some restrictions on showing vaccination cards and things like that, but in order to have those types of restrictions qualify you for the ERC, you have to show how it's a big impact to your business and really creating a burden almost, which I'm not sure that you can really claim that based on most organizations that we've seen out there. Of course, every organization has its own unique set of facts.
All right, perfect. Thank you. And I know we're down to the last 3 minutes here, and we are getting some questions, and like people want to be double, triple sure that if you received a PPP loan, you can indeed still apply for this tax credit. Can I go ahead and can you just kind of do the recap of that just to make sure it sits in everybody's heads here? Of course.
So yeah, originally when this credit came through with the CARES Act back in March of 2020, you could not have both programs working together. So it was either PPP or ERC. You couldn't have both. But then that was retroactively changed in December of 2020. And so Congress, with the law that they passed in December, they made a retroactive change that if you had one of those original PPP loans in 2020, or if you got a PPP loan in 2021, you could have both credits happen or both programs happening at the same time. You just can't double dip on wages. And so you have to be able to bifurcate out how those wage dollars are going to be allocated between those different programs. But yes, you can in fact have both going on. I definitely recommend having both going on. Most of our clients have both going on. So yes, I know there's been a lot of confusion with that over the years.
Yep, and a reminder to everyone, One Eastside Spark does have an agreement with Clark Newber and Sarah, so that if you need some one-on-one assistance, please reach out and let us know so that we can help you try to get these credits. And I think we've bumped up to the end of our time. I think we have some outstanding questions that we'll try to go ahead and get answered offline and send the answers to you. But this does conclude our program for today. I want to thank all our speakers for giving us your time and expertise. We really appreciate each and every one of you. And I want to say thank you to all our partners you see here on the screen who are working hard to support our business community. Also want to make sure you bookmark this site. This is oneeastside.org/spark. And there you will find key resources, information on our one-on-one advising, our weekly webinars, grant opportunities as they can become available, and more. And a big thank you to all of you for participating in our webinar today. So until we see you again, this concludes our webinar. Thank you for coming.